Two of my close friends, Alex and Ben. 10 years ago, Alex and Ben graduated together and landed jobs at the same company. They started with the exact same salary, $2,000 per month. Both were young, ambitious, and stood on the exact same starting line. But a decade later, their lives had diverged in ways you wouldn't believe. Alex's mistake, the rat race trap. First, let's talk about Alex. He lived the way most of us do. Work hard, play hard. Every time Alex got a raise, say to $3,000, the first thing he did wasn't saving, it was upgrading his lifestyle. He bought the latest iPhone on an installment plan and moved into a high-end apartment. He told himself, "I work exhausting hours. I deserve to enjoy the best things in life." Alex eventually held 3 credit cards, using them for designer clothes and luxury vacations. His numbers looked like this: income, $3,000. Expenses, rent, parties, installments, $2,800. Balance, a mere $200 left, but even that usually vanished during weekend outings. The result? Alex fell straight into the rat race. He had to work like a machine just to pay off credit card interest and monthly bills. He lived in constant stress because if he lost his job for even 1 month, his entire life would collapse. He had become a slave to the very money he worked so hard to earn. Ben's strategy, mastering the fast track. Then there was Ben. He wasn't necessarily smarter than Alex, but he understood the power of numbers. Ben applied a golden rule that I always emphasize: pay yourself first. The moment Ben received his $2,000 salary, he immediately moved 20%, or $400, into a separate investment account. He disciplined himself to live on the remaining $1,600. The biggest difference was that Ben knew how to distinguish between good debt and bad debt. He refused to buy luxury items on credit, bad debt. Instead, he accumulated capital and used it as leverage to get a bank loan for a small studio apartment to rent out, good debt. Take a look at Ben's speaking numbers. He took a $70,000 bank loan to buy the property. Each month, the mortgage, principal plus interest, was $800. However, the rent he collected was $900. Net cash flow, plus $100 per month. You see, that house didn't take a penny out of Ben's pocket. The tenant was actually paying off the debt for him. This is how Ben entered the fast track. The outcome after 10 years. Fast forward 10 years, while Alex is still drowning in $20,000 of credit card debt and facing immense job pressure, Ben now owns 2 rental properties and a solid stock portfolio. Every month, Ben receives $2,500 in passive income, a figure even higher than his starting salary. Ben still works, but only because he loves it, not because he has to. He has an army of dollars working for him 24/7.
In this video, I want to share something I didn't realize before. I was working really hard, but in reality, I was helping other people get rich. When I was younger, I was just like most people. I was taught to study hard, get good grades, so I could land a stable job with a good salary and solid benefits. It sounded completely reasonable, and I believed it was the right path. Then I was told to work even harder so I could afford my dream house. I used to think that was the most important investment in life. I also heard things like debt isn't bad, especially mortgages, because you can take advantage of interest rates and tax benefits. Or messages like buy now, pay later, low monthly payments, act fast before it's gone. And honestly, I got pulled into that mindset too. But after a while, I started to realize a pretty uncomfortable truth. When I work a job, I'm helping my employer get richer. When I take on debt, I'm helping banks and lenders make money. When I pay taxes, I'm contributing to the system. And when I spend money, I'm helping businesses grow their profits. Basically, almost everything I was doing was helping someone else move forward financially. The thing is, I had been programmed this way from a very early age without even noticing it. I was so focused on other people's goals that I completely overlooked building my own financial path. Instead of creating my own money system, I was feeding into someone else's. And for years, I kept working hard, but I wasn't really getting ahead the way I expected. It wasn't until I took a serious look at my income, expenses, assets, and debts that I realized if I didn't change, I'd stay stuck in that loop forever. That's when it hit me. It's time to start taking care of my own financial life first.
Let's look at the stories of two friends, Alex and Ben, to see the clear difference between minding other people's business and minding your own. Alex, the path of minding everyone else's business. Alex is a classic example of someone pre-programmed to make others wealthy. He's an excellent employee who pours his heart and soul into his company. Who is Alex making rich? Making the boss rich. Alex works tirelessly from morning to night, contributing all his ideas and energy to grow the company, making the owner wealthier by the day. Making the bank rich. Every time Alex gets a raise, instead of investing in himself, he uses credit cards and bank loans to upgrade his lifestyle, new cars, a flashier apartment. Alex's mortgage and credit card debt are the bank's most profitable income streams. Making the government rich. Alex is a model taxpayer. With his high salary comes high income tax, directly enriching the national treasury. Making other businesses rich. As an enthusiastic consumer, Alex spends most of his income on clothes, gadgets, and vacations. Every dollar he spends makes another business owner wealthy. Alex followed conventional advice without a second thought: buy now, pay later, and low, easy monthly installments. Consequently, after years of hard work, Alex has nothing but a mountain of debt and a life entirely dependent on his paycheck. Ben, the path of minding his own business. Ben started at the same point as Alex, but he quickly understood the nature of the financial game. Ben knew that to be wealthy and free, he had to start minding his own business. What did Ben do to mind his own business? Building his own asset column. Instead of using his income for consumption or debt, Ben applied the golden rule: pay yourself first. He immediately set aside a portion of his income into an investment account. Minimizing debt. Ben realized early on that debt was the biggest hurdle to financial freedom. He focused on reducing debt, starting with the highest interest rates. Living simply before living luxuriously. Ben practiced contentment, being happy with what he had. He didn't rush to show off his wealth while his financial foundation was still shaky. He understood that slaving away for a dream home, which really makes the bank rich, wasn't a smart way to mind his own business. Distinguishing good debt versus bad debt. Unlike Alex, Ben knew how to use debt as leverage. He only borrowed when it was good debt, loans that generate passive income, like a mortgage for a rental property. Ben was not pre-programmed to mind others' business. He didn't focus on making his boss, the bank, or the government rich. Instead, Ben used his intelligence and effort to find and build his own financial fast track.
The mistake of thinking more money solves everything. Many of us believe that just having a higher-paying job or hitting a jackpot will make our financial problems vanish. But the truth is quite the opposite. The more money you have without knowing how to manage it, the deeper you'll sink into trouble. Why is that? Because most of us are taught how to read, write, and drive, but no one teaches us how to manage our own pockets. As a result, when our income increases, we tend to spend more lavishly, shop more, and pile up even more debt. A hard-earned lesson. People who cannot control their own cash flow will eventually end up working for those who can. Be the CFO of your own life.
You need a shift in perspective. Stop looking at earning money as just a way to pay bills. Start learning to control your cash flow like a CFO running a major corporation, and that corporation is your life. If you don't learn to control it, then no matter how much your salary grows or how high you climb the career ladder, you'll always find yourself living hand to mouth. Don't fall into the trap of running out to take on new debt every time you get a raise or a promotion. Who is smarter, you or your bank? Most people today don't even have a clear personal financial statement. At most, they just check their bank balance at the end of the month to see how much is left to spend. To become wiser, even wiser than the bank holding your money, you need to set specific financial goals. Complete a personal financial summary, know exactly where every cent comes from and where it goes every single day. Once you master these numbers, you've stepped into the circle of leaders rather than constantly struggling in the rat race of money. Making money is a talent, but keeping it and making it work for you is a skill set.
The trap of more money, more debt. Alex has always lived by the mantra, once I get that raise, all my money problems will vanish. When Alex got promoted, his salary jumped from $2,000 to $3,000. Instead of controlling the extra cash, Alex immediately ran out and got deeper into debt. His actions: he upgraded to a flashier car on an installment plan and took out a loan for a luxury apartment. The result: Alex's cash flow remained zero or negative because his expenses and debts always raced to catch up with his income. He didn't get richer, he just started working harder to feed the banks and creditors. He isn't the CFO, he is just an employee working to pay off his own bills. Ben, the CFO of his own life. In contrast, Ben understood that the most important skill isn't making money, it's managing money. Ben took on the role of a senior CFO for the business called Ben's Life. When Ben earned more, he didn't see that extra money as a license to spend. He sat down and created a financial statement for himself. His actions: Ben tracked every dollar flowing in and out. Instead of using his raise to buy doodads or liabilities, luxury items, high-interest debt, he used it to acquire assets or pay down old debts. The wisdom: Ben understood that banks are smart. They want you in debt so they can collect interest. Ben decided to be smarter than his bank by setting his own financial goals and balancing his own financial statement every single month. Most people only know how to balance their checkbook, checking how much is left to spend, rather than preparing a true financial statement. The difference: Alex only looks at his bank balance at the end of the month to decide what to buy. Ben looks at his financial statement to see how much his assets have grown and if his passive cash flow is large enough yet. Your debt is someone else's asset. There is a truth I remind myself of every single day. Every single debt you carry is an asset in someone else's hands. Think about it. When you take out a loan to buy a house or a car, when you borrow for education or swipe your credit card, in reality, you are working for the people who lent you that money. You are working yourself to the bone just to build someone else's wealth. That is why we must be extremely cautious before signing any loan agreement. Don't confuse good debt with bad debt. From my own experience, I divide debt into two very clear categories. Bad debt. These are the loans you must pay back with your own sweat, tears, and labor every month. Examples include consumer debt or buying things that lose value over time. If you carry this kind of debt for 30 years, you will be a slave to it for 30 years, with no reward waiting for you once it's finally paid off. Good debt. This is the kind of debt that someone else pays off for you. For instance, I might borrow from a bank to invest in a rental property. The bank lends me the money, but the tenant is actually the one paying the principal and interest every month. That is how you use debt to build wealth. The golden rule: pay yourself first.
I've observed that most people fail to get ahead financially because of one common mistake. They prioritize paying their bills every month. Phone bills, electricity, water, credit card debt, groceries, they pay everyone else first. At the end of the month, if there is anything left, which usually there isn't, they finally set something aside for themselves. My hard-earned lesson is reverse that process. Pay yourself first to invest in assets, then find a way to manage your other expenses later. If you don't control your cash flow, you will always be working for those who do. The rat race versus the fast track. If you keep using credit cards and borrowing just to spend because of a good credit score, you are sinking deeper into the rat race, a place where you work hard just to pay off debt only to take on more debt to survive. To step onto the fast track, the path to true freedom, you need to recognize the relationship between the lender and the borrower. Don't be fooled by offers of flexible payments or premium credit cards. Focus on creating assets that run themselves and bring money back to you. Understanding where your money comes from and where it goes is the ultimate key to escaping the grind of just making a living.
Example from Alex. Bad debt. Alex just took out a bank loan to buy a brand new car and a luxury condo to live in. Every month, Alex must use his salary to pay the principal and interest. If the loan is for 30 years, he has committed to being an employee for the bank for 3 decades. The bank won't give him a gold watch when it's paid off. They only take his money. The car and condo here are liabilities because they take money out of Alex's pocket every month. Example from Ben. Good debt. Ben borrowed the same amount as Alex, but he used it to buy a rental property. Analysis. Ben uses the rent collected from his tenants to pay the bank mortgage. In fact, after expenses, he even has a small profit left over. The result. Ben has debt, but his tenants are paying it off for him. This is good debt because it allows Ben to own an asset without direct labor. Financial statements always have two sides. An expense in your financial statement is always an income in someone else's. For Alex, credit card payments, electricity, gas, and groceries are all expenses for Alex, but they are income for the bank and utility companies. Alex is paying everyone else first and only paying himself last, if anything is left. This is why Alex is stuck in the rat race. For Ben, Ben understands the golden rule, pay yourself first. He prioritizes setting aside investment capital before paying bills. Ben makes himself the payee rather than just the payer. The rat race, Alex's flow. Income comes from a job, flows straight into expenses and liabilities, loans or credit cards. Money exits to enrich the lenders. Alex is trapped in a loop. Work, pay bills, broke, work again. The fast track, Ben's flow. Income invested into assets, business or real estate. Assets generate new income. This income flows back into the asset column. Here, debt, loans, is used as leverage to expand the asset column. Are you in the rat race or the fast track? Here's a reality check. Earning more money won't necessarily solve your problems if your financial management foundation is broken. Many people see their cost of living skyrocket as soon as their income increases, leaving them empty-handed at the end of the month. This is the rat race, running endlessly but getting nowhere. On the flip side, those who master the numbers and understand exactly where their cash is flowing are the ones who enter the fast track. In that world, money works for you rather than you being a slave to money. How to take control of your cash flow? To start making a real change, I set some very practical principles for myself. Map out a clear spending plan. Don't let your money evaporate. Sit down and track your spending habits. You'll be shocked at how much you're wasting on things you don't actually need.
Minimize debt. Debt is the heavy anchor holding you back. Do everything in your power to cut it down. Live simply before aiming for luxury. I always tell myself to practice living with enough, being content with what I have before trying to show off or expand my material lifestyle. The golden rule: pay yourself first. This is the most important lesson I've ever applied. Most of us wait until we're done spending to save what's left, which is usually nothing. My approach is this: the moment I receive my salary or any income, I immediately set aside a specific percentage, like 10 to 20%, into a separate account. This is my investment in the future. Crucial note: you must absolutely not withdraw this money until you are truly ready to invest it and let it grow. My debt cleanup strategy. If you're feeling buried under debt, here is the exact snowball method I used to get clean in just a few years. Step 1. Cut the cards. Keep only 1 or 2 essential credit cards. Credit cards are a double-edged sword. It's best to limit them. Step 2. Earn extra. I pushed myself to earn an extra $150 to $200, a few million VND, every month. If you can't find a way to earn more, financial freedom is just a pipe dream. Step 3. The snowball effect. Use that extra income to pay off only one debt, like the card with the highest interest, in full. Pay only the minimum on everything else. Once that first debt is gone, take the entire amount, extra income plus the old payment, and smash it into the second debt. Your payment power grows like a rolling snowball, wiping out car or home loans faster than you'd ever believe. The final goal. Once I wiped out every trace of consumer debt, I took that total monthly amount and started building my own asset column. This is the moment your money officially starts working for you. It sounds simple, right? But the hardest part is discipline. If you stay the course, in just 5 to 7 years, your wife will be in a completely different league. I hope these personal insights help you on your own journey with money. Which step of this roadmap are you currently on? Let me know in the comments.